Imagine waking up every morning knowing that your investment portfolio is generating passive income, while also appreciating in value over time. But which path should you take to achieve this financial freedom, investing in real estate or stocks? When it comes to building wealth, many people are torn between these two options. On one hand, real estate seems like a tangible and stable asset class that provides rental income and potential long-term appreciation. On the other hand, stocks offer liquidity, diversification, and potentially higher returns on investment. Before diving into the pros and cons of each option, let's consider some context. The average American owns about 4% of their wealth in real estate, while the rest is tied up in other assets like stocks, bonds, and cash. This might seem counterintuitive given that many people perceive real estate as a safer investment. However, this perception may be based on historical trends rather than a thorough understanding of the underlying risks. When evaluating an investment, it's essential to consider both its potential returns and associated risks. Let's break down some key benefits and drawbacks of investing in real estate versus stocks. One of the primary advantages of real estate is its ability to generate rental income, which can provide a relatively stable stream of passive income. For example, if you purchase a $200,000 property with a 20% down payment, your annual mortgage payments might be around $9,500, and after deducting taxes and other expenses, your net operating income could be around $15,000 per year. However, there are also significant risks associated with real estate investing. For instance, tenant vacancies can result in lost rental income, while property maintenance and repair costs can eat into your profits. Furthermore, local market conditions can significantly impact property values. So if you buy a property at the wrong time, you might end up holding an asset that's worth less than what you paid for it. Stocks, on the other hand, offer investors a relatively liquid way to participate in the growth of companies around the world. By buying shares in established businesses with strong track records and competitive moats, you can potentially earn higher returns on your investment compared to traditional bonds or savings accounts. But investing in stocks also comes with its own set of risks, particularly if you're not well versed in market analysis or company fundamentals. A single stock crash can wipe out a significant portion of your portfolio, leaving you wondering what went wrong. Furthermore, fees and commissions charged by brokerages and investment managers can erode your returns over time. To better understand the trade-offs between real estate and stocks, let's look at some historical data. Over the past 50 years, the S&P 500 has averaged around 10% annual returns, while the median value of a U.S. home has increased by about 5-6% per annum. However, if you're considering investing in real estate, it's essential to think beyond just these broad trends and look at local market conditions. For example, during the 2008 financial crisis, the housing market in some areas plummeted by as much as 50%, while other regions barely felt a blip. One of the most significant advantages of stocks is their potential for high returns on investment. However, this comes with increased volatility and risk, particularly if you're not diversified across multiple asset classes or sectors. To mitigate these risks, many investors opt to diversify their portfolios by allocating some assets to real estate through various vehicles like real estate investment trusts or real estate mutual funds. These investments allow individuals to tap into the benefits of real estate investing without having to manage physical properties themselves. However, not all investment options are created equal, and it's crucial to understand the underlying mechanics before making any decisions. For instance, REITs often have their own set of fees and expenses, which can eat into your returns over time. Moreover, some investors might prefer a hands-on approach of managing physical properties, but this comes with its own unique set of challenges and responsibilities. For example, being a landlord requires handling tenant relations, dealing with maintenance issues, and navigating local zoning regulations, tasks that require significant time and expertise. Now, let's examine another key aspect: liquidity. Stocks offer investors the ability to quickly sell their shares if needed, providing a degree of flexibility in case of unexpected expenses or financial emergencies. On the other hand, real estate investments often have liquidity risks due to the lengthy process involved in selling properties. However, some savvy investors might argue that this lack of liquidity is actually an advantage when it comes to building wealth over the long term. By tying up assets in illiquid investments like real estate or private equity, you're essentially forcing yourself to hold onto these assets for a longer period, which can lead to higher returns through compounding. But what if I told you that there's another way to think about liquidity as an opportunity cost? When holding on to a highly liquid asset like cash, you might be missing out on the chance to invest in potentially high-growth areas or sectors. By sacrificing some short-term flexibility, investors can gain access to higher returns and diversification benefits through liquid investments. Now that we've explored some of the key differences between real estate and stocks, let's revisit our initial question: which path should you take to achieve financial freedom? While there's no one size fits all answer, it's essential to consider your personal risk tolerance, investment goals, and time horizon before making any decisions. If you value stability and predictability in your investments, real estate might be a better fit for you. However, if you're willing to take on more risk and volatility in pursuit of potentially higher returns, stocks could be the way to go. Ultimately, it's crucial to understand that both options come with their own set of pros and cons, requiring careful consideration and analysis before making any investment decisions. As we conclude this discussion on the benefits and drawbacks of real estate versus stocks, remember that investing is a marathon, not a sprint. By taking the time to educate yourself and tailor your strategy to your unique needs, you'll be better equipped to navigate the ups and downs of the markets and achieve financial freedom over time. So, what will it be, the stability of real estate or the potential for high returns on stocks? The decision is yours, but one thing's certain. By making informed choices about where to allocate your assets, you'll be taking a significant step towards securing your financial future.